Today on Coffee with Your Retirement Coach, we're going to talk about how to be more generous with the organizations that you care about in your family and not Uncle Sam. All right, grab your favorite mug. It's time for Coffee with Your Retirement Coach. Welcome back to Coffee with Your Retirement Coach. Today, I think I've got a common problem.
Aaron, tell me.
It's the kids. I mean, they're not the problem, but it's the holiday season.
Yeah.
I'm trying to do equal and fair gifting, but I got another family member getting in the way.
Oh, who's that?
It's not the wife. I know. When I saw the eyebrow, I knew what you were thinking.
Yeah.
It's my favorite uncle.
Your favorite uncle?
Yeah, Uncle Sam.
That's your favorite uncle?
He gets the biggest at this time of year. When we look at that spreadsheet, his column is fat.
Fair point.
But I think you and I can talk about how the idea of what we owe in a way of taxes and our generosity, how those two items can come together.
I love that, Aaron, because, you know, I've been dwelling on this comment, this idea that combining generosity with smart financial planning is one of the best things we can do.
It is. And under the current law, they actually play well together.
They do. You know, knowledge is power, Aaron.
Attention holiday shoppers. You know, speaking of knowledge, we learned a valuable lesson.
We've missed you, buddy.
Listen. I'm back.
You're back.
And everybody's going to get full Aaron this week. That's a guarantee. So we were in New York recently.
Yeah.
And the family.
Do we want to mention when?
Well, I'm getting there.
Okay.
The family wanted to go to Macy's.
Yeah.
And we were like, oh, yeah, well, we need to go today.
The Macy's of all Macy's.
Herald Square. We need to go today because we're heading home soon. So we headed to the Herald Square Macy's, and as we go to enter the place, we realize something. It's Black Friday. We have lost our minds.
Your ever-loving mind.
The crush of humanity was overwhelming.
Well, Aaron, you're such a gentleman. And I know
we don't have to tell this story.
We have to.
We don't have to tell this story.
Aaron, I'm not doing this podcast without the people. The people need to know.
All right, we're going to take a little sidetrack to the point of this story.
He's a gentleman.
I'm a Southern gentleman, and when I came to enter the store, people are everywhere, and there is a couple that are absolutely struggling. So I open the door, help them get situated and get out the door, and then I work on getting my family inside, and then we all get in and get situated the best that we can. And then Peyton, my son, my youngest, he goes, "That's the guy that you helped out." And he was being arrested. Him and his female counterpart. Apparently, the North Face jackets in their arms were not their own. They were property of the Herald Square Macy's. Still, there had been no transaction.
So I'm pretty sure we're going to hashtag this later. Aiding and abetting a criminal.
That's where Parker, my oldest, went. He said, "Oh, Dad, I think they're going to want to talk to you. That's you played a strong hand in there, almost escaped."
Yeah.
But the reason that we bring this up is because there's often times where we get excited if we're wanting to get a gift, although sometimes it's going to be out of obligation. It's to honor the relationship with someone and to show them that we care. We're celebrating the birthday, the holidays, a milestone, whatever. And then when you go to the store or you go online to try and figure out what they might want, what the size is, all of that stuff, it can rob you of some of the excitement of the gifting.
Yeah, well, in this time of year, it's easy to lose focus on what really the purpose of this, time of year is. And as we're celebrating the best gift in the world, the ultimate gift,
it's easy to lose focus.
Our Lord, I mean, it is. And but today, I thought it'd be really awesome to focus in on not the gift receiving, but the gift giving.
Well, and Nick, that's where I was headed. If we're doing sometimes a more substantial gift, and a lot of times, and a large portion of our audience is retirees, they get excited about legacy or gifting while they're alive, making charitable contributions.
Making an impact, yeah.
But just like we felt the crush and there was the trade-off of our time and our comfort in that store, Uncle Sam can take a big piece, and all of a sudden, our gift, when shrunk down, it can get frustrating. Yeah. And we've seen it for some of our clients. It's almost pushing to the point of, I don't even want to do it. If I have to take that kind of a haircut, if this much has to get lost in the transition, I don't even know if I want to do it.
Yeah. So, Aaron, I think there are a few things that really hinder people from making really smart moves, okay? And when, we talk about smart moves today, it's smart moves with our charitable giving. So we want maximum tax benefit, maximum impact. And how do we marry those two together?
That's right.
Maximize the impact to those organizations that we care about, our loved ones, but also just be really smart about it, right?
Well, and bring back the feel good to it. We can get excited about it. It takes knowing the rules, being aware of the options, but that's what we're going to go over today. If these things resonate with something that you've been feeling inside that you wanted to do for a child, a grandchild, an organization that you care about, our hope is that these, listeners are going to come away from this, episode thinking, I could do that. Need to have a conversation with a CPA, need to have a conversation with my financial planner, but I've got a better method of attack for that thing that maybe I've always wanted to do, but now really kind of have an idea of maybe one of the paths I might take.
Sure.
So let's kind of start going through those, Nick. Speaking of Uncle Sam and the inevitable taxes, we've talked on the podcast before about required beginning dates and required minimum distributions. And for people that are planning towards that or in the thick of it, QCDs have proven an awesome opportunity to partner with their generosity. Can you explain what again, we talk about alphabet soup, what that acronym stands for and kind of where you fall into the crosshairs when it's appropriate?
Yeah, well, first of all, it is alphabet soup. So, I know when I first got in the industry, one of the things our founder, who's my dad, he said things need to be sophisticated enough to work well, but easy enough to understand.
So important.
So let's unwind some of this, all right? So a QCD is Qualified Charitable Donation, okay? And now, in order to do this, you have to have an IRA or some form of retirement account, okay?
Right.
And this is probably the closest thing to having your cake and eating it too, especially when it comes to taxes, okay? Now, a lot of people think that you have to wait till required minimum distribution age to start doing QCDs. But actually, the IRS allows for you to start it as early as 70 and a half. Now,
I want you to say that again. Required beginning distribution planning doesn't have to begin the year that you start. We can, years in advance, start talking about things like QCD and Roth conversion.
Oh, absolutely.
Conversations appropriate way ahead of time. I've got a few clients that I'm hoping they're hearing this.
Yeah. So, so now we've got the new RBD, alphabet soup, right? Required beginning date for IRA holders. That's age 73.
Correct.
But the IRS says, hey, if you want to do this cool thing, this QCD, this Qualified Charitable Distribution, and I'm going to share with you how powerful this is in just a second, we're going to let you start that as early as age 70 and a half. Now, here's the power of this. If I take a distribution, just any kind of distribution out of a normal traditional IRA or 401k, it's going to count as income on my income tax return.
Right.
And I'm going to have to pay taxes on that asset or that distribution, right? So I'm going to have to pay taxes. And if it counts towards income, it could push me into higher tax brackets.
Absolutely.
Right? Ouch.
Yeah.
Well, and then if we love the organizations we care about, we're writing the check on Sunday, we're giving to those, the museum or whatever, okay? Mm-hmm. We're making those gifts out of cash. What if there was a better way? Here's the better way.
Yep.
If you're 70 and a half and you have an IRA or a 401k, you can fill out a distribution form and elect a QCD. And that same $10,000 you were giving to that organization you care about, you can give it out of your IRA. Now, why would somebody do that? The power in this is really two things. One, when you take that distribution for the QCD, it doesn't count as ordinary income on your tax return, right? And number two, it's a non-taxable event.
That's right.
It's even better than getting a tax deduction, writing the check. It's great you get that tax deduction, but if it comes directly out of the IRA to that organization you care about as a QCD, it's not counted as income, and it's a non-taxable event. It is literally having your cake and eating it too.
And the question that we get from our clients, Nick, is where does the other shoe drop? And it doesn't. Not a taxable event for you and not a taxable event for the charities and organizations that we care about.
Yeah. No. And so If you are interested, we always say this in like every episode, seek wise counsel. Okay, there's a few nuances to make this work. Number one, Aaron, your hands can't touch the money. So you can't say, send me that $10,000 from that IRA.
Yep.
Don't withhold the tax, and then I'm going to give it to whoever, right? A 501c3 of my choice. You can't do that.
Yeah, common misstep.
Right? That's a common misstep. That's going to count as ordinary income on your tax return.
Yeah.
Maybe push you into higher brackets. And yes, you will get a deduction, but you might as well have just written the check. Okay.
Right.
So you've got to follow the appropriate steps to make this happen and happen right.
Yeah. No. It's so important, Nick. Now, so that would be leading up to our required beginning date when required minimum distributions begin. That if we don't take under the current law, there's a 25% penalty. Can I count those qualified charitable distributions towards my RMD after I pass my required beginning date?
And here's what's so perfect, Aaron. I know you know the answer. Yes.
Yes.
So if you don't need the distribution, like you don't need that required minimum distribution,
right?
And let's just say it's $30,000 this year for you.
Yeah.
And you normally give $10,000 away. You can take that $10,000 as a QCD, point it in the direction of the charities and organizations you care about.
Right.
And then you only have the $20,000 remainder that you have to take as a required minimum distribution.
The sweet thing gets sweeter is what you're telling us.
Absolutely. Now, there is a limit. You can only do this up to just over $100,000. It is being indexed. I think it's $108,000 or $109,000 next year. I can't remember the exact number, but the bottom line is if your required minimum distribution is all the way up to $100,000, you could QCD the full $100,000 to those organizations you care about.
And those would be the guardrails that we often talk about. We want to make sure two things. One, it needs to stay within the limits, stay within that 100K. And then the other piece is if this money does not meet a budgetary need, if you don't need your required minimum distribution for operational costs within the home, then we're talking about these plans. And again, that's why I want to talk to our CPAs, financial planners, want to seek wise counsel. So while we're talking about that, let's talk about the next step up. And this is one that I get really excited about because I feel like for people that are generous now and know they're going to remain generous and they need multi-year planning to come alongside that, donor advised funds, the DAF, a whole nother acronym, but yeah, donor advised funds. Nick, let's introduce that.
Yeah. Well, I think donor advised funds are one of the most misunderstood and most unknown planning tools in the charitable giving world right now that anyone in the middle class could use.
Absolutely.
I mean, this is not a wealthy person tactic or tool, although many really affluent people, including clients we have, I mean, they use this as a planning tool. But the bottom line is this can be used for so many people, and it's so inexpensive to do, Aaron. It's so easy. It's inexpensive. So here's the idea.
The level of tax planning that it unlocks is worth those nominal costs.
Oh, so big. So again, we're going around this idea of we want to be smart with our financial planning and have this high impact charitable giving. So here's the idea. I coined a term years ago, and it was this term called bunching deductions. Okay. And really, I've heard people use it in different contexts, but the way we use it is if I know that I'm going to give $10,000 a year now for the next 5 years, as an example.
Right.
Okay. And so I know that's going to happen. And I look at my bank account, my savings account, I look at my brokerage account, and I identified $50,000. Okay. Now we can, drill down in this in just a second, but I could take $50,000, put it inside a donor advised fund. Mm-hmm. And when I do that, I'm getting 5 years worth of deductions in 1 year.
Yeah.
Okay. Well, why would you do that? Well, let's say you had a really big bonus you weren't expecting and you want to offset the taxes on that. Or let's say, in the way that we do it in our firm mostly, we want to get really aggressive with getting more tax-free money.
Yeah.
So we're going to look at doing of 5 years worth of a Roth conversion all in 1 year. Now that money inside that Roth, being tax-free now, gets half a decade of tax-free growth versus doing a little bit each year for those 5 years. So it allows us to front load Roth IRA conversions, get the big deduction up front. But the power of the donor advised fund is I can choose when I gift it. And again, it's got to be to a 501c3, or it's got to be a charity, right? It's got to be a legit organization.
Correct.
Right? But I can change my mind. I might love this particular missionary serving, somewhere around the world, and I want to give to the organization that supports them. Or maybe it is, maybe we had a loved one that lost their lives to cancer or something like that. Well, maybe we want to give there. Or maybe it's the local history museum, or maybe it's whatever.
Yeah.
Okay. We can direct how much money we want to go to those organizations. We can direct the frequency, and we can change our mind. The only thing we can't do is that this is considered a completed gift, so we can never claw that money back into our own hands to use it for discretionary spending.
One-way street.
So once it's in there, it has to be marked for giving.
Right.
But you know what, Aaron? Here's the thing. Instead, for 5 years, maybe I say I've had a lot of growth in it because it was invested inside.
And that's the point that I feel like people are trying to understand the concept, and they miss that other added value. What goes in can be invested. And so these assets can be earning interest, dividends. They can grow.
Yeah. So if I put in $50,000 over the course of the 5 years, it could have grown to $65,000, and I've paid zero taxes on the growth of that money. I will pay no taxes on any of that profit, and the organizations that receive the profit will pay no taxes.
Do you want to hear a funny story with this?
Talk to me.
It's been a fantastic year. We're recording this at the end of 2024. The markets have done well.
Yeah.
I've got a client that this year they started their donor advised fund, right? And we've been gifting out of it. They gave us the instructions, the information, everything we needed so that their charitable obligations are still being met and in the same time frame that they were previously doing. No interruption. We had a review, and they looked at their donor advised fund. Now, again, it's been a strong year in the market. They said, when are we going to start giving? And it's like, we've already started giving. We've met the obligations for this year. And they're like, no. The amount that's in there is the amount that I put in. Yeah. And I said, that's because it's invested. Now, it's not going to be the same every year.
Yeah.
But what an exciting thing in the year that they chose to be generous, that they stepped in, they saw that, and they saw those results. And again, we're talking about marrying financial planning with our generosity. What a neat moment for them to have begun.
Oh, 100%. Man, I love that story.
Yeah.
And you and I have a lot of stories with how people have used this thing over time. And, in a few minutes, we'll talk about a really, really high impact strategy with a donor advised fund.
Yeah.
But the big takeaway here is you can establish a donor advised fund. You can name it what you want to name it. Like mine's called the Yeoman's Family Foundation, I think. Okay. We can direct the frequency and the amount that's given. Mm-hmm. We can stop and start gifts anytime we want.
Right.
It can be invested, and most of these that I've reviewed are extremely low cost. I mean, even in our firm, Aaron, we cut our costs basically in half when we're overseeing these things, because we want to maximize the amount of money that's going to the organizations that these people care about.
Absolutely. I love that. And I love that we do that. So for this particular avenue, Nic, Guardrails for here, we would want to make sure that we realize it's a one-way street. We don't want to put anything in there that we're not going to be able to live without. The other thing is we want to speak to our financial professionals. We want to be mindful of the standard deduction in that year. That number is going to play in big when you compare that to because 5 years worth of giving is different for every individual. So again, when we're kind of working through those things, as we're going to say with almost every topic that we put on here, great conversation to have with financial professionals.
Oh, absolutely. Well, and I like that you're bringing that up because, again, smart financial planning here, tying it together with that, when are you retiring if you're not retired? Right?
Yeah.
Timing that out.
Absolutely.
Or timing when you're receiving a lump sum distribution, timing when you expect to receive an inheritance, timing, the sale of a property that was highly appreciated. Like all of these things need to be considered. And that's why financial planning is so important is, we want to be very intentional. We want to be haphazard. Like you were talking about earlier, I don't want Uncle Sam to be my biggest beneficiary.
Yeah.
but through sometimes some good things that we do that weren't best, we overpay Uncle Sam all day long.
Absolutely. Nic, we're about to transition. We're going to talk about gifting highly appreciated assets, but we have a pretty incredible story from this year as well about how this tied in with donor advised funds. If we kind of,
I love it.
Some of these things play well together. Can you kind of talk about how something that had such a good feeling to it, but then Uncle Sam's portion kind of brought the feelings down, but then it's like, don't worry, you're not stuck. Can you kind of walk us through that scenario with these clients?
Oh, yeah. So we've got some amazing clients. I mean, we work with some of the most generous people, really. Yeah. And most of our folks are salt of the earth, middle-class millionaire type folks, okay? But here's the deal. We've got this client that it was a multi-generational client. Okay, we worked with 3 generations of this family.
Yeah.
Okay, and the patriarch of the family, he passes away. He and his wife had both passed, and they had left the family in a trust, this highly appreciated asset that has grown for over 40 years.
Right.
Okay.
And there's a punishment to that success.
There's a big punishment because it's 90% profit that's never been taxed. Unfortunately, in the type of trust that was set up for this family, and not discussed by the attorney, by the way.
Gotcha.
Okay, this is a type of trust that does not give a step up in basis when the grantor passes away.
Yeah.
Okay, so here we have again 90+% of a really highly appreciated asset, all profit,
subject to capital gains.
All subject to capital gains. And this couple is extremely kind, extremely generous, very faithful people. And so, they're writing checks everywhere.
Oh, so many different organizations.
So many, right?
Tell me something you care about. They probably do too.
Yeah. And so as we were talking, we identified, hey, this is something they're probably going to continue to do.
Yeah.
Right? So what a lot of people don't realize is that without selling the asset, we could pick up shares of the asset and pull it from that trust, and we could place it inside that donor advised fund.
Yeah. Taxable event?
Non-taxable event. We paid 0 taxes in capital gains.
Right.
And we got a tax deduction.
Yeah.
Because it went into the donor advised fund.
Right.
So not only did we legally not pay taxes on capital gains, we also got a deduction.
Right.
Now, when you gift highly appreciated assets, there is a different way that's calculated than cash.
Correct.
Again, seek wise counsel.
Yes.
However, what a high impact for them.
Yeah. Now, sometimes you don't just sell an asset to take the cash out to buy something. You might want to reallocate the way that you're invested. But the situation for them is whether it was touched or sold to reallocate, that gains was going to happen. Now, inside the donor advised fund, already reallocated to an allocation that makes sense in today's market.
Absolutely. And what we did, Aaron, is we effectively, to your point, we took it from being in one single position, one single asset.
Right.
And now it's well diversified, and they've paid no taxes to do this. And it's so low cost. Again, it was a win-win-win for the client.
So that's talking about inheritance. When would gifting an appreciated asset be appropriate? And what does that look like? And what would be the reasoning behind that? Because that's where we're headed.
Yeah. Well, Aaron, what I really like is, a lot of our clients like the idea of being a living legacy today.
Yeah.
Right. So
I want to see it.
They want to see the children and the grandchildren that they're gifting to be able to enjoy it. And maybe it's helping them start a small business, or maybe it's helping them purchase a new safe car because they've got young children and they want to make sure they get from point A to point B. So there's all these different reasons, and sometimes it's just a I love you Christmas gift at the end of the year that the client says, look, they don't need stuff. They got stuff. We just want to give them some cash.
Yeah.
Right?
Yeah.
And so many times our clients are in higher tax rates than the children and then the grandchildren.
Absolutely.
Right? And so a lot of people don't necessarily realize this, but there is a 0% capital gains rate if you don't make a certain amount of money. So what if we took that highly appreciated asset, and let's say we were going to give $1,000 to 5 different grandkids. Right?
Yeah.
So that's $5,000. What's the capital gains rate of that grandkid? Probably 0.
Exactly.
Right? Probably really low. 0 or 15% maybe, but let's say 0.
Yeah.
So now I've taken a highly appreciated asset. I've given them $1,000 of shares, to the 5 grandkids.
Yeah.
Now, mom and dad can help them sell it if they need help, or they could sell it on their own if they're of age, and they pay 0 taxes to do it.
Right.
It was better for the client to keep the cash.
Yes.
To give them the appreciated asset.
Yeah.
And they've paid no taxes to do this.
Right.
This is a sweet, sweet deal, and it's overlooked all the time.
Let's put it in some layman terms, and this is not advice. This is just
Right.
I want to give money to my kids or grandkids. I was planning on giving them $1,000. I bought that NVIDIA stock that did really well. And if I touch it, I'm going to get penalized. I could give them $1,000 worth of NVIDIA, and then the $1,000 that I would have given them, I could invest in more NVIDIA after a certain amount of time, or something else. This is not a super wealthy strategy. This is anybody that has got appreciated assets. It's a great way to wipe out the gains if you're already charitably inclined or in a generous mood, depending on how the kids acted.
Right.
The list has been checked twice. We just need to look at it.
Yeah. So being very intentional, it definitely matters. And once again, we are not advising or recommending any individual stock or security.
None.
But that is a great example of real life clients that have owned that particular holding.
Yeah.
And it's such an easy thing to give when you've got such a massive amount of appreciation versus cash. So if you need help or you want to ask questions about how best to go do that for your kids or grandkids, hit us up. Connect@yourretirementcoach.com.
Yes.
Connect@yourretirementcoach.com. If you have questions about how to structure a qualified charitable donation, a donor advised fund, or gift to the next generation highly appreciated assets, we'd love to talk you through how to do that.
We read those emails because the coaches aren't just behind the clipboard. They're behind the keyboard. So, Nick, can you kind of hit me? And I know time-wise we need to kind of start wrapping things up. Could we just do some rapid-fire other things that might be appropriate or just conserve? One of the big things that you and I keep saying is if you're going to give it thought.
Yeah.
Don't not give, but give it thought.
Yeah.
So some of the other things that I just like to knock off, revisit the bunching of the charitable contributions, a charitable remainder trust, and then, of course, the king, cash. Could we kind of hit those things in succession, and then I'll get us wrapped up and we'll get out of here?
Yeah, well, why don't we hit the easy one,
Yeah.
which is the last one first, okay? Cash. Cash is still cash. Everyone loves cash. It's the most, obviously liquid, easy to use asset. You're also going to probably get a higher percentage of deduction in gifting cash instead of a highly appreciated asset. Again, talk to your CPA or your financial professional. But that is certainly a very, very easy thing to give.
Right.
And who doesn't love cash?
Right.
I prefer cash over the gift card.
It always fits. I don't ever have to return it.
Yeah. The second thing, Aaron, that you just mentioned was, again, revisiting that idea of bunching deductions.
Yeah.
So you don't have to use a donor advised fund to give in multiple years. If you have a really excellent income year, this year's been extremely good for us in the market, as an example. Many people are getting bonuses because their companies have performed really, really well. Well, if you know that you're planning on giving next year, just like you gave this year, this year, Nick, we gave $10,000 to our church. We plan to give $10,000 again next year. Maybe consider bunching 2 years of gifting into this year and contact your church and let them know, hey, we're going to go ahead and bless you. We're going to make sure that you get this tithe or offering by December 31st, but it will be a 2024 and 2025 gift.
Yeah. No, that's great. Last thing in there, Nick, and I think this is one that people get anxious about, but for the ones that it truly fits, and it works. We've seen a lot of success in charitable remainder trusts.
Yeah. So charitable remainder trust, I think, are going to be a tool that's going to get more and more popular. And here's why. Now, there is the version of this in using a charitable remainder trust that I can take an asset that's appreciated. I can get a big deduction, sometimes even a multi-year deduction in placing it in a charitable remainder trust. And then that trust over my lifetime or my and my wife's lifetime, as an example, gives us income each and every year. So some people treat it almost like it's giving you a pension, okay? Yeah. And because you got that big deduction in that first year, 2 or 3 years, you're able to, not have to pay the taxes, obviously, right?
Right.
But during that period of time, at the end, you have to have, I believe it's 10% of the remaining balance. So you could have spent 90% of the asset, and that remainder amount, the charitable remainder trust, the remainder amount has to go to charity. It's got to go to the causes that you care about. But Aaron, once it's set up, you can change it throughout the course of that 20-year period of time of you taking distributions. You could change the organizations. You can change who the charity is or the nonprofit.
There's still flexibility within there.
Yeah, so it's a powerful tool. Now, we may visit this differently another day.
It definitely deserves a deeper look.
But if you are thinking about next generation and getting a retirement account to them with a Secure Act new 10-year rule, that retirement account has to be liquidated in most instances by the end of that 10 years for your beneficiaries, excluding spouses and disabled folks, some different nuances there.
Yeah.
But for most people, at the end of 10 years, it's got to be liquidated. Well, what if you wanted to stretch that retirement account over 20 years or a kid's lifetime? Well, looking at charitable remainder trust as the beneficiary of an IRA could be a really powerful planning tool.
Absolutely.
Now, Aaron, there's one that you didn't mention that I'd like to hit.
My list is not exhaustive.
It's a good list.
Thank you.
It's a good list.
What you got? Off menu.
You ready?
Yeah.
We have seen a lot of clients over the years want to help children buy homes.
Yes.
So one of the ways that we've looked at doing that, the problem is how much can you gift? Right. So you've got gift tax limits like $18,000.
Correct.
Right. Well, if a home is, $300,000 or $400,000 that you're wanting to gift to a kid, that far exceeds that $18,000
quickly.
Right. So, one quick idea of, with a concept of gifting is, what if you bought the home and you held the mortgage for the kid?
Mm-hmm.
And what if you structured the mortgage payment, as an example, to be approximately, I don't know, $18,000 a year?
Yep.
And what if you forgave $18,000 of mortgage payments per year?
Right.
So again, there's a lot that goes into that.
Should have been on my list because that's a
there's
fantastic
so much
one.
However, the point is, let's be smart about our financial planning.
Yes.
Let's get the biggest tax impact that we can get.
Yes.
And bless those individuals and those organizations we care about.
So of the things that we mentioned, here's where we want to kind of talk about what should be on your radar. In recap, if you have an IRA or a work plan, like a 401k, for instance, qualified charitable distributions, before and after the required beginning date within your age limits. Again, a great tool to be tax-free. These are tax-deferred assets, tax-free when it comes out, as long as you don't touch it, and it goes to the organization you care about. So it takes care of the obligation that you have already thought, hey, want to give to our church, want to give to the Boy Scouts, want to give to, the hospital, those kind of things. You can take care of that this way. So that's where those things need to be considered for you. If you're looking for flexibility and that bunching that we talked about, and you have the either appreciated assets or the cash to do it, the donor advised fund, again, it's one of those things where you've got to have the fuel to put in it, and we want to be mindful of the standard deduction, talk to CPA when we do it, but that's something, if you're looking for flexibility in there, the donor advised fund, something you want to kind of research, have further discussions on. Nic, anything else? So, appreciated assets, we want to avoid tax. If you, got that Home Depot stock that we deal with so many Georgia boys that are like, I've got it. Can't touch it.
Lockheed Martin,
exactly.
Coca-Cola, Delta. Yeah. Great companies.
It is what it is, Nick.
Yep.
No.
Well, Aaron, I think, here's the deal.
Yeah.
This podcast is all about really educating people and helping them ask the right questions in their own personal dynamic, their own scenario.
Yeah.
So here's what I'd like to do for our audience. If you're listening or watching today and you'd like more information, if you're like me, I'm a visual learner. And, us talking about this might expose you to a lot of information, but seeing it would help kind of further help your understanding. Contact us. Again, connect at yourretirementcoach.com. And we've got some great one-pagers and some fact sheets on these things. We'd love to get in your hands. We can email it to you, send you a printed copy here in the continental United States. But we'd love to share that information with you if that'd be helpful to you.
This time of year, Nick, the holidays remind us of what's most important, and that's our faith and our friends and our family. And if at this time you get inspired, you realize you want to do something, but it's too late for this year. Well, we're not talking about this year. We're talking about next Christmas. Well, how do we take the next steps for that? I want you to set a reminder for Christmas in July. That almost seems like something that should be marketed, right?
I love it.
We want you to make a note in your phone. Talk to your spouse or any partner or person that's going to be important in these conversations, as well as your financial professionals. And we want to make sure that you've got time next year to digest the repercussions of this tax-wise, these concepts. Make sure you've got plenty of time to talk with your financial professionals. And remember, for our CPA friends and our financial planners, there might be a time of year that's best. So reach out to them and say, hey, I would like to talk about a donor advised fund, or I would like to talk about qualified charitable distributions. When would be appropriate time to do that? Then you've got time to think about it, sleep on it, and get it processed and executed in time so that these can be meaningful Christmas gifts, meaningful year-end donations, and you don't have to worry about the time constraints.
I love it.
Yeah. So listen, to all of you guys out there, we want to thank you for being here, and we want to encourage you to stay coachable.
Hey, Aaron.
Yeah.
Before we sign off.
Yes.
Merry Christmas.
Oh, Merry Christmas, bud.
Merry Christmas.
Merry Christmas. We hope you enjoyed today's show, but you may have questions for our coaches, and they can be emailed at connect@yourretirementcoach.com. If you know someone that needs to hear this episode, we encourage you to share it. As a reminder, the content of this podcast is for educational and entertainment purposes only and should not be construed as advice. On behalf of our coaches, we want to thank you for listening and for being coachable.
Yeoman's Consulting Group, a registered investment advisor YouTube channel based in Marietta, Georgia. We strive to provide comprehensive wealth management services for every stage of the journey. This platform is solely for informational purposes and is not offering advisory services or sales of securities. Investing involves risk and possible loss of principal capital. Comments by viewers or recognitions are no guarantee of future investment outcomes and do not ensure that a viewer will experience a higher level of performance or results. Public comments posted on this site are not selected, amended, deleted, or sorted in any way. If applicable, certain editing of personal, identifiable information and misinformation may be deleted. The opinions expressed herein are as of the date of publication and are subject to revision due to changes in the market or economic conditions and may not necessarily come to pass. This podcast was filmed at Podium Studios at Marietta Square. Grow your business with turnkey, professional quality podcasting, live streaming, and online events. Don't worry about editing. Don't worry about anything. Just come in and record. Learn more at thepodium.studio. Step up to the podium.